if you look at money growth on a year-over-year basis, it was negative for, I think, about a year and a half, maybe more. Money is a leading indicator for inflation, and we do believe that inflation will go much lower than people expect right now. Wouldn't be surprised to see it go negative, especially if the consumer is worried about job loss, whether because of AI and automation generally, or what have you. So the saving rate tends to go up during those periods. And that will mean, we believe, that companies will have to price even more aggressively.
Wood makes an important distinction between harmful deflation and deflation driven by technological innovation. While deflation is often seen as a negative economic force, Wood argues that when it is caused by innovation, it can actually be a positive development. For instance, electric vehicle prices are coming down due to advancements in technology, not because of weak demand. This type of deflation makes products more affordable for consumers while preserving corporate margins, a scenario Wood believes will play out across multiple industries. She also touches on the issue of productivity, which has been stronger than expected. This has allowed companies to cut prices without sacrificing profitability, especially in industries benefiting from automation and artificial intelligence. According to Wood, this trend could persist throughout the year as more companies adopt AI and automation to improve efficiency.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
It's been very interesting to watch the revisions in economic activity. Until this report, the revisions in the employment numbers had been down, and they were much weaker than had originally been reported. You know, we look at earnings reports and look at their revenues, and we're seeing a lot of companies showing negative revenues. So, you know, the headline numbers are heavily influenced recently, certainly in terms of some of the upward revisions in personal income by transfer payments, that's government stimulus, and interestingly, dividends. But not, if you look at the economy, the cyclical part of the economy is sick. It's sick. If you look at the sectors in the economy, one by one, they've been falling into a recession, no matter what the headline numbers say. Housing went down immediately when the Fed started raising rates. We're down 20 to 40% still. That's a recession. You've got non-residential construction in recession. So, autos, very weak. We've got those sectors, and then you've got the small and medium business sector. Their confidence is at 08-09 levels. And we've got certain pricing measures, certainly the cyclical ones, that have been deflationary, actually. So one thing that I do think is going on that is helping is as prices are coming down and the consumer's getting better and better deals, and they're spending. So I think that is sustaining. You know, a lot of people say real growth causes inflation. In this case, and actually in history, most times if you cut prices, you'll get more activity. The consumer, as long as the labor market hangs in here, and yes, today was very reassuring that way. As long as the labor market hangs in here, and companies like Walmart and Costco and auto companies either increase their discounts or cut their prices, I think the activity will come. And the labor market will continue to hang in. But if they try and jack prices back up, it was very interesting to see FedEx, after turning positive in revenues and then turning negative year over year on revenues, basically saying they're going to use prices to make it up. I think that's going to backfire. And I think during the next year, that many people will understand how deflationary the undercurrents are in the economy. Now, deflation is not always bad. Part of it is because of innovation, technologically enabled innovation. The car prices, EV prices are coming down. Their costs are coming down too. So I think there's a lot of confusion in terms of what's going on out there because productivity is stronger than expected, giving companies the latitude to cut prices and salvage margins. If that sustains, great. This year, I mean, we're going to have to push it out because inflation did levitate as companies tried to price to make up for shortfalls in unit growth. It levitated in the 3.5% to 4% range. Now it's broken below 3%. And we're hearing more and more companies basically trying to attract consumer attention with lower prices. So yes, if you look at money growth on a year-over-year basis, it was negative for, I think, about a year and a half, maybe more. Money is a leading indicator for inflation, and we do believe that inflation will go much lower than people expect right now. Wouldn't be surprised to see it go negative. Especially if the consumer is worried about job loss, whether because of AI and automation generally, or what have you. So the saving rate tends to go up during those periods, and that will mean, we believe, that companies will have to price even more aggressively. In terms of over 5% unemployment rate, we could see it. We could see it. I will say today gave me pause in terms of this productivity dynamic and sort of companies may not, if they get the productivity growth from existing employees, they may not feel like laying them off. They can lower prices to keep consumer demand going.
Wood foresees a significant shift in the software industry, with companies moving away from traditional software as a service models toward platform as a service and infrastructure as a service models. This shift will be driven by the growing adoption of AI, which will enable companies to customize software solutions to their specific needs rather than relying on one-size-fits-all SaaS offerings. In this context, companies like Palantir, which offer customizable AI-driven software, are well-positioned to capture market share.
Our focus is on innovation, and something very important happened this past year. We were very concerned that excessive regulation was driving innovation off our shores, particularly when it came to crypto or digital assets. We've had a very hostile regulator. And the same, I would say, is true of the FTC in terms of denying M&A, because that has prevented a lot of innovative companies from enjoying liquidity events by selling out to bigger companies. I think we're hearing from both candidates that those two jobs are on the line, maybe for that reason. And we're seeing more alignment that innovation solves problems, and so we should not discourage it. So from that point of view, I'm happy to see the bipartisan movement here. We'll favor lower regulations every day when it comes to innovation. I don't think tariffs are a great thing at all for innovation and for economic activity. So there's something on both sides that will give us pause. But the most important thing is the biggest impediments to innovation. We think that we're developing clarity around what's going to happen at the SEC and the FTC. Well, we've been doing research on AI for 10 years now. That's why we were so early into Nvidia. We've obviously taken it down in most of our portfolios out of the flagship. One of the things that we've been looking for is the next big play. We think Nvidia is still a fine stock, But in terms of the unexpected out there, we do think it's going to be in the software layers. And as you know, Palantir has become a big position for us in the top 10. UiPath as well, it had a stumble, but it's coming back now. And I think as more and more people understand how well positioned it is, it will do very well. But a lot of the software companies that we think are going to benefit are in the private sector. And I'm thrilled that we have a venture fund that is really our purpose here is to democratize venture capital so that for $500, anyone can get access to OpenAI, which is the third largest position, or SpaceX, which is the largest position. But if you look at software, many people say, well, we have so many software companies in the public markets. What do you mean? And what we mean by that is we think that the software world's going to change fairly dramatically. And we're going to see a shift, maybe a share shift away from software as a service towards platform as a service. So think about Palantir and foundation models, and infrastructure as a service, so cloud. And the reason for that is because engineers are going to be made so much more productive, developers so much more productive by OpenAI and Anthropic and xAI and Google and Meta's Llama 3. We're going to see companies customizing their own software, customizing software for their own companies, as opposed to just going automatically to, one-size-fits-all software as a service.
Cathie Wood provides a nuanced and expert perspective on the current state of the economy and the role of innovation in shaping the future. While the cyclical part of the economy is in a deep recession, deflationary forces and productivity gains offer some hope for sustained consumer demand. Wood also highlights the critical role of AI and software innovation in driving future economic growth, and she expresses optimism that regulatory clarity will help foster innovation in the U.S. market. As ARK Invest continues to focus on disruptive innovation, Wood remains confident that the companies leading the charge in AI, blockchain, and other cutting-edge technologies will create significant value for investors in the years to come.
Please like and subscribe my channel.